If you have been told that index funds are the safest, cheapest way to build wealth, you need to hear this. The math that fund companies hope you never calculate reveals a different story. Those tiny expense ratios you see advertised compound over decades, quietly erasing hundreds of thousands of dollars from your retirement accounts. By the end of this video, you will understand exactly how these hidden fees work and what you need to do differently. This is not conspiracy theory. This is basic mathematics that changes everything about how you should think about passive investing. If you are serious about long-term wealth, hit subscribe now. The index fund. Illusion. What they're not telling you. Index funds are marketed with a simple pitch. Set it and forget it. Expense ratios under 0.20%. Passive investing at its finest. The fund companies show you that tiny percentage and tell you it is basically free compared to active management. Let me show you what that actually means in dollars. Take a portfolio of $100,000 invested over 30 years. The advertised expense ratio is 0.15%. That sounds negligible. But that stated fee is not the whole story. Beyond that advertised number, you are paying for trading costs every time the fund buys or sells securities to track the index. You are paying bid-ask spreads that never appear on your statement. If you hold these funds in a taxable account, you are dealing with tax inefficiency from capital gains distributions you did not choose. And there is cash drag from uninvested holdings sitting idle while the market moves. When you add up the real total cost, you are looking at 0.40 to 0.60% annually, not 0.15%. Now let me show you what that difference actually costs you. Assume a 7% annual return before fees. With the advertised 0.15% fee, your $100,000 grows to roughly $740,000 over 30 years. With the true total cost of 0.5%, that same investment grows to about $600,000. That hidden cost just erased $140,000 from your retirement. The problem is not that index funds are bad investments. The problem is that the marketing makes you think you are paying almost nothing when the real cost is 3 to 4 times higher than advertised. Fund companies structure fees this way deliberately. A fraction of a percent feels insignificant. You see 0.15% and your brain registers it as basically zero. You do not calculate what that means over decades because it seems too small to matter. But compounding works both ways. Just as your returns compound, so do your fees. Every dollar you pay in fees is a dollar that stops compounding for you and starts compounding for the fund company. Think about the other financial decisions you obsess over. You compare mortgage rates to save a quarter point. You pay off credit card debt to avoid interest. You negotiate your salary for an extra few $1,000s. All of those matter. But this fee structure costs you more than any of those decisions over a lifetime of investing. And most investors never even look at it. The math gets worse when you factor in down markets. When your portfolio drops 20%, you still pay the same percentage fee. That means you are paying fees on money you just lost. The fund company gets paid regardless of performance. Fee drag accelerates exactly when you can least afford it. Now that you see how these costs actually work, let me show you what happens when you let this run for decades. The compounding trap. Why small fees destroy long-term wealth. Let me walk you through exactly how this trap works over time. Two investors start with the same amount, same market returns, same time horizon. The only difference is fee structure. Investor A pays 0.23% total annual fees. Investor B pays 0.5%. Year 1, the difference is barely noticeable, maybe a few $100s. Year 5, it is a couple thousand. You can ignore that. It does not feel meaningful yet. But watch what happens at year 15. The gap is now tens of thousands of dollars. At year 25, it is 6 figures. By year 35, Investor A has nearly $200,000 more than Investor B. Same contributions, same market. The only variable is that 0.30% difference in annual fees. This is the compounding trap. The cost feels negligible today, so you ignore it. By the time you realize the damage, decades of wealth have already transferred from your account to the fund company. Your brain is wired to focus on immediate, tangible costs. You feel a $50 bank fee. You notice a $10 price increase on your streaming service. But a 0.30% annual fee on a portfolio? That registers as background noise. Fund companies understand this psychology perfectly. They designed the fee structure specifically to exploit it. If they charged you $5,000 up front, you would question it. But charge you 0.5% annually, and most investors never calculate what that actually means over a lifetime. Here's another way to think about it. That 0.5% fee is not just 0.5% of your current balance. It is 0.50% of everything your money could have grown into. Every year, you are paying fees on the returns you did not get because you paid fees the year before. The math is recursive. The fees compound against you exponentially. Now consider what happens in a down market. Your portfolio drops 25%. You just lost a quarter of your wealth. But you still owe the same percentage fee. So now you are paying fees on a smaller balance while your recovery is further delayed by ongoing fee drag. The fund company does not share your risk. They get paid whether your portfolio grows or crashes. That fee comes out regardless of performance. In the worst years of your investing life, when you need every dollar working for you, the fee drag accelerates. Compare this to the financial decisions you actually lose sleep over. You refinance your mortgage to save half a point on interest. That might save you $30,000 over 30 years. You aggressively pay down credit card debt at 18% interest. Smart move. But that 0.30% difference in investment fees? Over a 40-year investing career, that costs you more than your mortgage interest and credit card debt combined. And most people never even look at it. This is why fee structure matters more than almost any other investment decision you will make. It is not about timing. It is not about picking the right stocks. It is about understanding the math of compounding and making sure it works for you instead of against you. Now that you understand the trap, let me show you what actually works. The strategic alternative, building wealth without the hidden tax. This is not about avoiding index funds entirely. Index funds can be the right tool. The key is understanding total cost and structuring your portfolio to minimize fee drag. Strategy 1. Compare true total costs, not just advertised expense ratios. Look beyond the number in bold at the top of the prospectus. Ask about trading costs. Ask about tax efficiency. Calculate the real annual drag on your returns. Most investors stop at the expense ratio. You need to go deeper. Strategy 2. Use tax-advantaged accounts strategically. In a Roth IRA or 401k, tax drag disappears. That eliminates one of the hidden costs entirely. Save your least tax-efficient holdings for these accounts. Use taxable accounts only for investments with minimal distributions and high tax efficiency. Strategy 3. For larger portfolios, consider direct indexing. Instead of buying a fund that tracks an index, you own the actual securities in that index. This gives you control over when you realize gains. You can harvest losses for tax purposes. You eliminate the fund company middleman. This approach works best once you have several $100,000 invested, but the savings can be substantial. Strategy 4. Rebalance intelligently. Every time you trade, you pay costs. Bid-ask spreads, commissions, potential tax consequences. Rebalancing is necessary, but doing it too frequently destroys value. Set thresholds. Only rebalance when allocations drift beyond a specific percentage. Use new contributions to rebalance instead of selling and buying. Now the counter-argument. Active management has even higher fees. Mutual funds charging 1 to 2% annually are worse. So what is the solution? The answer is ultra-low-cost index funds in the right account types, combined with strategic asset location. You want total annual costs below 0.15% if possible. You want tax-efficient fund structures. You want to minimize unnecessary trading. Small changes in fee structure compound to massive wealth differences over decades. Moving from 0.50% to 0.19% in total costs can mean an extra $200,000 in retirement. That is real money. That is financial security. The index fund is not the enemy. The enemy is paying more than you need to and not understanding the true cost. The index fund is not a lie, but the marketing around free passive investing is. Those tiny fees are not tiny over 30 years. They are the difference between a comfortable retirement and financial stress. Calculate your true total cost of ownership across all investment accounts. Add up expense ratios, trading costs, and tax drag. If that number is above 0.20%, you are leaving serious money on the table. If you want to understand asset location strategy and how to structure accounts for maximum efficiency, check out the next video. Subscribe for more wealth building frameworks that go beyond surface level advice.